There's a pattern in history that has annihilated every global reserve currency without exception. Not most of them, every single one. And what should terrify you is this. The pattern is so precise, so mathematically consistent, that once you see it, you can't unsee it.
The Portuguese real dominated global trade for 80 years, then vanished. The Dutch guilder ruled for 80 years, then collapsed. The British pound reigned for 105 years, then died. Each followed the exact same 7 stages. Each believed they were invincible. Each thought their currency was permanent, and each was catastrophically wrong. The US dollar became the world's reserve currency in 1944. That's 81 years ago. And right now, in 2025, the dollar is deep into stage 5 of this 7-stage death cycle. This isn't speculation or fear-mongering. This is documented historical mathematics, a sequence that has executed flawlessly 4 times across 6 centuries. And the brutal truth? We're not approaching the danger zone. We're already inside it.
The only question that matters now is whether we're smart enough to see what's coming, or arrogant enough to believe, like every empire before us, that this time is different. Understanding reserve currency power, the ultimate economic weapon. Before we dissect the 7 stages of death, you need to understand what a reserve currency actually represents. It's not just a strong currency. It's not even the most valuable currency. It's something far more powerful. It's the currency that other nations are forced to hold in their central bank reserves. The currency used to price every major global commodity. The currency that international trade cannot function without.
When you control the reserve currency, every country on Earth needs your money. Want to buy oil? You need dollars. Want to settle trade imbalances? You need dollars. Want to hold safe assets during crisis? You need dollar-denominated bonds.
This creates what economists call exorbitant privilege, and it's the closest thing to a financial superpower that exists. You can print money and export it to buy real goods. Other countries must produce actual goods to earn your currency. You literally exchange paper for their labor. You can run endless trade deficits without consequence. Foreign nations need to accumulate your currency for reserves, so your deficits become their problem, not yours. You can borrow at artificially low interest rates. Global demand for your bonds isn't discretionary, it's structural. Nations must buy them whether they want to or not.
Being the reserve currency is the ultimate economic weapon. It's why empires fight wars to achieve it, and why they collapse into irrelevance when they lose it. And what history proves with chilling consistency is this: no one keeps it forever. The cycle is inevitable, the timeline is predictable, and the stages are universal. Now let me show you the 7 stages that every reserve currency follows without exception, and exactly where the dollar sits in this death cycle right now.
Every reserve currency in history began the exact same way, with overwhelming military power that controlled the critical arteries of global commerce. Not just having a powerful military, but using that military to dominate the pathways through which all international trade must flow.
In the 1450s, Portugal achieved something unprecedented. They mastered oceanic navigation, while other European nations were still hugging coastlines, terrified of the open sea. When they rounded the Cape of Good Hope in 1488, they didn't just discover a new route. They discovered how to bypass the Ottoman-controlled land routes to Asia entirely. And then they militarized this advantage with ruthless efficiency.
Portuguese warships dominated the Indian Ocean, the South China Sea, and the Atlantic. They established fortified trading posts at every strategic choke point: Goa, Malacca, Macau, Mozambique. These weren't friendly ports. They were armed fortresses where Portuguese cannons decided who could trade and on what terms. Want spices from the Moluccas? Deal with Portugal. Want to trade with India? Get Portuguese permission.
This military stranglehold on trade routes made the Portuguese real the only currency that mattered. Merchants across 3 continents needed reals to conduct business in Portuguese-controlled waters.
The currency became global not because it was backed by gold or economically superior, but because it was backed by cannons.
The Dutch followed the same playbook, but perfected it. The Dutch East India Company wasn't just a trading company. It was a military superpower with corporate shareholders. At its peak, the VOC commanded 40 warships and 20,000 soldiers. They conquered Portuguese trading posts, seized control of the Spice Islands, and made Amsterdam the center of global trade. Dutch ships dominated every critical sea lane: the Baltic, the Atlantic, the Indian Ocean. If you wanted to trade anywhere in the world, you needed guilders.
Britain took this model and scaled it to unprecedented levels. At its peak, the Royal Navy had more warships than the next 5 nations combined. Britannia rules the waves wasn't patriotic poetry, it was geopolitical fact. The British controlled every critical choke point for global trade: the Suez Canal, Gibraltar, Singapore, the Straits of Malacca. The pound sterling became the global currency because British naval power made it impossible to conduct international trade without it. Stage 2. Massive trade surplus, the Golden Age. Once you control trade routes, wealth begins flooding in from across the world, not through theft or exploitation alone, but through systematically advantageous exchange. You control the terms, you set the prices, and the balance of trade flows relentlessly in your direction.
Portugal in the 1500s ran absolutely massive trade surpluses. They bought spices, silk, and porcelain from Asia using gold and silver. Then they sold European goods, textiles, weapons, and African slaves at markup rates that would make modern corporations blush. Portuguese ships returned heavy with Asian goods that sold for 10 times what they paid. This surplus transformed Lisbon into one of the wealthiest cities in Europe. The Portuguese crown's revenues from trade were so enormous that they funded the entire government without heavily taxing their domestic population.
The Dutch in the 1600s took this even further. Amsterdam became the warehouse of the world. Goods from Asia, the Americas, and Africa, everything flowed through Amsterdam. The Dutch didn't just trade, they were arbitrageurs on a planetary scale, buying low in one market, selling high in another, and capturing the spread on every transaction. The Dutch trade surplus was so colossal that Amsterdam became synonymous with wealth. The canals were lined with mansions. The city's merchants were individually richer than many European kings.
Britain in the 1800s ran the largest trade surplus in history up to that point. They exported manufactured goods, textiles, steel, machinery, ships to the entire world. They imported raw materials, cotton, tea, rubber, at prices dictated by British buyers, not sellers. The terms of trade were set in London. The surplus built Britain into the wealthiest nation on earth. London's financial district handled more capital than the rest of Europe combined.
The United States experienced the most dramatic trade surplus in human history from 1945 to 1970. After World War II, America was the only major industrial power with intact infrastructure. Europe was rebuilding from rubble. Asia was devastated. The U.S. exported machinery, automobiles, steel, and consumer goods to a desperate world. The trade surplus was so enormous that dollars flooded into foreign central banks faster than they could be recycled. U.S. gold reserves swelled to over 20,000 tons by the 1950s, more than the rest of the world combined. This is Stage 2, massive trade surpluses, the accumulation of global wealth through dominant positioning. The dollar achieved this from 1945 to 1970. Check. But here's where the pattern begins its inevitable turn toward destruction. Stage 2 doesn't last forever. Eventually, every reserve currency nation transitions from producing goods to consuming them, from exporting to importing, from running surpluses to running deficits. And that's when Stage 3 begins, the beginning of the end.
At some point, the world formalizes what's already obvious. They officially adopt your currency as the global reserve. Treaties are written, agreements are signed. Your currency becomes the standard. This is the peak, the moment of maximum power. And it's also paradoxically the moment when the seeds of destruction are planted.
For Portugal, this happened in the early 1500s. European nations and Asian merchants officially recognized the real as the primary currency for international transactions. For the Dutch, it happened in the mid-1600s. The guilder became the currency of choice for international contracts. Even the British East India Company used guilders because Amsterdam's financial markets were the deepest and most liquid in the world.
For Britain, it happened at the Congress of Vienna in 1815, after the Napoleonic Wars. The pound sterling was explicitly recognized as the global standard. International treaties, loans, and trade contracts were denominated in pounds. The gold standard that most nations adopted was effectively a pound standard because Britain controlled the rules.
For the United States, it happened at Bretton Woods in 1944. 44 nations met in New Hampshire and formally agreed to make the dollar the world's reserve currency. Other currencies would peg to the dollar. The dollar would peg to gold at $35 per ounce. The International Monetary Fund and World Bank were created specifically to manage the system. It was the most explicit formalization of reserve status in history.
But here's what nobody tells you about Stage 3, what every empire learns too late. This is the peak. This is as good as it gets. Because formalizing reserve status creates the seeds of its own inevitable destruction.
Once you become the reserve currency, the world needs your currency more than they need your goods. So you stop producing goods. You start importing instead. The trade surplus that built your power reverses into a deficit, and the deficit becomes permanent, structural, inescapable.
This is called the Triffin dilemma, named after economist Robert Triffin, who explained it in 1960. Here's the trap. For the world to have enough dollars to use as reserves and for trade, the U.S. must run trade deficits. The U.S. must send dollars abroad continuously. But running endless deficits undermines the value of your currency. It's mathematically impossible to be both the world's reserve currency and maintain a strong trade balance.
This is where the pattern becomes irreversible. The reserve currency nation stops producing wealth and starts consuming it. The trade surplus that wants to find their power flips into a deficit that will never reverse. Portugal saw this in the mid-1500s. The trade surplus vanished. Instead of exporting goods, Portugal was importing everything. Grain from Sicily, textiles from Flanders, manufactured goods from across Europe. They paid for this with gold and silver from Brazil and Africa. But here's the critical point. They weren't producing wealth, they were spending wealth accumulated earlier. The Portuguese crown's spending exploded. King John III spent lavishly on palaces, churches, and the royal court. Military expenses to maintain the empire drained resources constantly. And they didn't notice the problem because the money kept flowing. But the gold wasn't infinite, and they weren't building anything productive with it. They were just consuming.
The Dutch in the 1700s followed the same trajectory. After a century of trade surpluses, the Dutch became net importers. Amsterdam's accumulated wealth made its citizens comfortable. Why work in factories when you can live off capital? Dutch investment shifted from trade and production to finance. They became bankers to Europe, lending to other nations instead of producing goods themselves. The trade balance reversed. They imported more than they exported, paying for it by liquidating accumulated wealth.
Britain in the early 1900s faced the same reversal. By 1900, Britain was running trade deficits. They imported food, raw materials, and increasingly manufactured goods. They paid for this with returns on overseas investments. Centuries of accumulated wealth invested in railroads, mines, and enterprises across their empire. The investment income was enormous, but it was extracting wealth created elsewhere, not creating new wealth at home. British manufacturing declined. Factories that had led the Industrial Revolution were closing or falling behind American and German competitors.
The United States entered Stage 4 in 1971. That's when the trade surplus permanently reversed into a deficit. By the 1980s, the deficit was growing rapidly. By the 2000s, the U.S. was running the largest trade deficit in human history, $800 billion annually. The U.S. imports far more than it exports: consumer goods, electronics, automobiles, textiles, everything from abroad.
How is this financed? By exporting dollars, by printing currency and exchanging it for real goods produced by other nations. This only works because the dollar is the reserve currency. Other nations need dollars for reserves and trade, so they accept them. But make no mistake, this is living beyond your means, consuming more than you produce. And it's the exact same pattern that preceded the collapse of every previous reserve currency.
Stage 4 is the point of no return. Once the deficit becomes structural, once production moves offshore, once consumption becomes the economic model, there's no going back without catastrophic economic pain. Check. Stage 5. Currency debasement and money printing, the desperate measure. When deficits become unsustainable, when you can't borrow enough to finance your spending, there's only one option left: debase the currency, print money. Every failing reserve currency has done this, every single one.
Portugal did this in the 1550s. Facing deficits and declining trade revenues, the Portuguese crown began debasing the real. They reduced the silver content in coins. They issued more currency than they had metal to back it. Inflation exploded. Prices rose. Merchants began refusing reals or demanding more of them for goods. By the 1570s, the real was losing credibility. International merchants started preferring other currencies for trade.
The Dutch did this in the 1700s. The guilder had been backed by a strong banking system and conservative monetary policy for generations. But by the mid-1700s, the Dutch government was borrowing heavily to finance wars and maintain their colonial empire. When borrowing became too expensive, they began inflating the currency, printing money to cover deficits. The guilder's value declined steadily. By the 1780s, it was no longer the preferred currency for international trade. Britain debased the pound through 2 world wars. World War I forced Britain to print money and abandon the gold standard temporarily. World War II forced them off gold permanently. By 1945, the pound was floating and losing value. Britain printed money to rebuild and fund the welfare state. The pound devalued repeatedly in 1949 and 1967. Each devaluation eroded international confidence. By the 1970s, the pound was no longer a reserve currency. It was a regional currency.
The United States entered Stage 5 in 2008. The financial crisis forced the Federal Reserve to print money on a scale never seen in peacetime. Quantitative easing, $3.5 trillion created from 2008 to 2014. Then COVID hit, $7 trillion more printed from 2020 to 2022. The money supply expanded faster than at any time in American history outside of wartime.
This is currency debasement, not by reducing metal content in coins, but by expanding the supply of fiat currency exponentially. And the effect is identical. The dollar's purchasing power declines. Inflation surges. In 2021 and 2022, inflation hit levels not seen in 40 years. The difference between the US and previous reserve currencies is scale. The dollar is global. When the Fed prints, it exports inflation to every economy on Earth. Other nations watch their dollar reserves lose value. This is the stage where confidence begins to crack, where the world starts to notice. And once confidence erodes, Stage 6 follows with brutal inevitability. Check.
Stage 6. Loss of confidence and search for alternatives. The breaking point. This is when the world starts looking for exits. When trust in the reserve currency erodes and nations begin actively shifting reserves to alternatives. This stage isn't theoretical or distant. We are living through it right now.
Portugal lost confidence in the 1570s and 1580s. International merchants began demanding payment in Spanish silver or Venetian ducats instead of Portuguese reals.
Asian merchants who had accepted reals for decades started refusing them or demanding larger quantities. By 1580, when Spain annexed Portugal, the real was already functionally dead as a reserve currency.
The Dutch guilder lost confidence gradually through the 1700s. By the 1780s, Amsterdam was no longer the financial center of Europe. London had taken that position. The guilder was still used in regional trade, but not for major international transactions. The shift was gradual, but irreversible.
The British pound lost confidence rapidly after World War II. In 1949, Britain devalued the pound by 30%. International holders of pounds lost almost a third of their value overnight. Confidence collapsed. Nations began shifting reserves from pounds to dollars aggressively. By 1960, the pound's share of global reserves had fallen from over 60% in 1945 to less than 20%. The transition from pound to dollar was complete within just 15 years.
The US dollar is in the early stages of stage 6 right now. The signs are everywhere, undeniable and accelerating. China and Russia began reducing dollar reserves in the 2010s. They've been buying gold instead, thousands of tons. China's official gold reserves have more than doubled since 2008, but unofficially, analysts believe they hold far more. Russia liquidated nearly all its U.S. Treasury holdings after 2014 sanctions.
The BRICS nations, Brazil, Russia, India, China, South Africa, have been actively discussing alternatives to the dollar for trade. In 2023, they announced plans for a BRICS currency. It hasn't launched yet, but the fact that it's being discussed openly is historically significant. Saudi Arabia, which has priced oil exclusively in dollars since 1974, the foundation of the petrodollar system, began accepting yuan for oil sales to China in 2023. This breaks a 50-year precedent. The petrodollar system is cracking.
Central banks globally are diversifying reserves aggressively. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. That's a 14 percentage point decline, representing trillions of dollars shifted out of dollar assets into euros, yuan, and gold. Even small nations are reducing dollar exposure. Thailand, Malaysia, Indonesia, they're negotiating trade agreements that settle in local currencies instead of dollars. This is the beginning of stage 6, the world searching for alternatives, not because they hate America, but because they see the same pattern that destroyed every previous reserve currency: endless deficits, currency debasement, loss of purchasing power. They're not waiting for stage 7. They're positioning now, before the collapse. Check.
Stage 7. Replacement and collapse. The end. This is when a new currency rises to replace the old, not through formal agreement or international treaty, but through market adoption. The world simply stops using the old currency and starts using the new. It happens suddenly, violently, and completely.
The Portuguese real was replaced by the Spanish silver peso in the late 1500s. Spain had conquered vast silver mines in the Americas, Potosí in Bolivia, Zacatecas in Mexico. These mines produced more silver than the rest of the world combined. Spanish silver coins became the preferred currency for international trade because they were abundant, standardized, and backed by ongoing production. The real, debased and declining, couldn't compete. Merchants refused it. The transition happened over 2 decades. By 1600, the real was irrelevant.
The Dutch guilder was replaced by the British pound in the late 1700s and early 1800s. Britain's Industrial Revolution and naval dominance made the pound the obvious successor. London's financial markets became deeper and more liquid than Amsterdam's. The pound was backed by British manufacturing and trade power. The transition took about 30 years. By 1815, after the Napoleonic Wars, the pound was the undisputed global standard.
The British pound was replaced by the US dollar from 1945 to 1960. The transition was formalized at Bretton Woods, but took years to complete in practice. Britain was bankrupt after World War II.
The US held most of the world's gold and had the only intact industrial base. The dollar was the only currency that could serve as a global standard. The pound collapsed in a series of devaluations. By 1967, it was clear the dollar had fully replaced it.
So, what replaces the dollar? That's the trillion-dollar question everyone's asking. And the honest answer is, it's not clear yet, because we're not at stage 7. We're in stage 6, the search for alternatives.
But history gives us clues about what the replacement must have. The replacement currency comes from the nation with military dominance over trade routes, a trade surplus, and massive productive capacity. Right now, that's not any single nation.
China has the trade surplus and production, but it doesn't control global trade routes militarily. The yuan isn't freely convertible. China's capital controls prevent it from being a true reserve currency. You can't be the reserve currency if people can't freely move money in and out of your country.
The euro is the second most held reserve currency, but Europe has deep structural problems. Aging population, no unified fiscal policy, dependence on external energy. Germany has the production, but Southern Europe doesn't. It's a fragmented system.
Gold is increasing in appeal. Central banks are buying more gold than at any time since the 1970s. Gold can't be printed or debased, but it can't scale to handle trillions in daily transactions. There's not enough gold in the world to back the volume of global trade.
The most likely scenario is a messy transition, a period of multipolar currency competition. Several regional currencies used in different trade blocs, the dollar in the Americas, the euro in Europe, the yuan in Asia, gold for settlement between blocs. This wouldn't be clean. It would be volatile, unstable, and economically brutal. But it's how transitions happen when there's no clear single successor. And this is exactly where we're headed.
Why this matters to you: the human cost of currency collapse. Understanding this pattern isn't academic, it's survival. When reserve currencies collapse, it doesn't just affect governments and central banks. It destroys ordinary people's savings and wealth. Portugal's collapse in the late 1500s caused economic depression across the Portuguese Empire. Merchants who held reals saw their wealth evaporate overnight.
The Dutch collapse in the 1700s devastated Amsterdam's middle class. Savings held in guilders lost value. Investments became worthless. Families that had been comfortable for generations were impoverished. Britain's collapse after World War II impoverished an entire generation. British citizens who held pounds, who had government bonds, who had pensions denominated in pounds, they all lost massive purchasing power as the currency devalued repeatedly. Savings that should have funded comfortable retirements bought less and less.
And the American collapse? It's happening in slow motion right now, every single day. Every dollar you hold is losing purchasing power. Since 2020, the dollar has lost roughly 25% of its value through inflation. Your savings, your paycheck, your retirement account, if it's denominated in dollars, it buys 25% less than it did 5 years ago.
And this is just the beginning of stage 6. If the pattern holds, and 4 historical examples say it will, the next decade will see accelerating decline, more inflation, more loss of purchasing power, more nations dumping dollars, more trade settling in alternative currencies.
And when stage 7 arrives, when the replacement actually happens, there will be a moment of acute crisis, a currency collapse. The dollar could lose 50% of its value in a matter of months. This happened to the pound in 1949. It happened to the guilder in the 1780s. It can and almost certainly will happen to the dollar.
What you must do, positioning for the collapse. So what do? How do you protect yourself when the world's reserve currency is following a 600-year pattern toward inevitable collapse?
First, understand that holding dollars is not a safe haven. It's a risk. The dollar is losing reserve status slowly now, but accelerating.
Diversify out of pure dollar exposure immediately. This doesn't mean abandon dollars entirely. You need dollars to live if you're in the US. But don't hold all your wealth in dollars or dollar-denominated assets.
Second, hold assets that maintain value regardless of what currency is used. Real estate, productive businesses, commodities like gold and silver, skills and knowledge. These preserve wealth across currency transitions.
Third, watch the Stage 6 indicators closely. Watch central bank reserve data. If you see accelerating declines in dollar reserves globally, that's confirmation the transition is speeding up. Watch trade agreements. If major nations start settling trade in other currencies at scale, that's a critical sign. Watch gold prices. If gold surges dramatically, it means the world is fleeing fiat currencies generally.
Fourth, understand this isn't political, it's mathematical. This isn't about whether you like or dislike American policy. It's not about left or right, Democrat or Republican. It's mathematics. The same mathematics that destroyed the real, the guilder, and the pound.
Every reserve currency follows the same 7 stages, and the dollar is in stage 5, moving rapidly into stage 6. The pattern doesn't care about American exceptionalism. It doesn't care about military power or economic size. It cares about deficits, debt, and debasement. And on those metrics, the US is following the script with terrifying precision.
The timeline. Why we're out of time. Let me show you something that should genuinely terrify you. The timeline.
The Portuguese real lasted 80 years as reserve currency, from 1450 to 1530. The Dutch guilder lasted 80 years, from 1640 to 1720. The British pound lasted 105 years, from 1815 to 1920. Each currency lasted roughly 80 to 110 years. The US dollar achieved reserve status in 1944. That's 81 years ago. We're at the average lifespan, and we're exhibiting every symptom of late-stage decline. Massive deficits, currency debasement, loss of confidence, search for alternatives.
The pattern says what comes next is stage 7, replacement and collapse.
What makes this time genuinely different and worse? Here's what's genuinely different this time, and this is truly meaningfully different, not the usual "this time is different" delusion.
Every previous reserve currency collapse was regional. When the real collapsed, it affected Portugal and its trading partners. When the guilder collapsed, it affected Amsterdam and Northern Europe. When the pound collapsed, it affected Britain and the Commonwealth.
But when the dollar collapses, it's global. The dollar is embedded in every economy, every central bank, every trade transaction, every commodity price. Oil, gold, wheat, all priced in dollars. When the dollar loses reserve status, there's no part of the global economy that remains unaffected.
This means the transition will be more chaotic, more violent, more destructive than any previous shift in history. There's no clear replacement ready to absorb the role. The scale of dollar-denominated debt globally, over 70 trillion in bonds alone, means that a dollar collapse triggers cascading defaults across every continent.
Emerging markets that borrowed in dollars won't be able to repay. Corporations that issue dollar bonds will face bankruptcy. Even developed nations that hold dollar reserves will see their central bank balance sheets implode.
The systemic risk is orders of magnitude larger than 1949 when the pound collapsed, or 1780 when the guilder fell. This isn't just a currency transition. It's a restructuring of the entire global financial system. And restructurings are never smooth. They're painful, chaotic, and destructive to existing wealth.
The final truth: prepare or perish. Let me be absolutely clear about what I'm saying and what I'm not saying. I'm not saying the dollar will collapse tomorrow. I'm not saying the US will become a failed state. I'm not saying you should panic and liquidate everything.
What I'm saying is this. The pattern exists. 7 stages, 4 historical examples, perfect mathematical consistency, and the US dollar is currently in stage 5, entering stage 6.
The timeline says we have maybe 10 to 20 years before stage 7.
maybe less if the transition accelerates, maybe more if the US can somehow break the pattern.
But breaking the pattern requires something no previous reserve currency managed. It requires reversing the deficits, stopping the money printing, rebuilding productive capacity, accepting short-term economic pain for long-term stability.
These aren't just policy choices. They're politically almost impossible because they require short-term pain for long-term gain. Democracies don't vote for pain. They vote for comfort, for stimulus, for printing money to avoid hard choices.
So the pattern continues. Stage 6 accelerates toward stage 7.
And the people who understand this, the people who study history instead of ignoring it, they position themselves accordingly. They diversify out of pure dollar assets. They hold real assets that preserve value. They watch the indicators carefully. They prepare for the transition. And when stage 7 arrives, when the replacement happens, they're not caught holding a collapsing currency. They're holding assets that maintain value across any currency system.
This is what the Portuguese merchants who saw the real collapsing did. They shifted to Spanish silver early. This is what the Dutch bankers did when the guilder declined. They moved wealth to London before the collapse.
This is what the British elite did after World War II. They moved wealth to dollars and dollar assets before the pound's final devaluation.
And this is what smart money is doing right now. Not all at once, not in a panic, but systematically, quietly, over years. The wealthy and well-informed are already positioning for the dollar's decline.
The undeniable pattern. The reserve currency death pattern isn't a conspiracy theory. It's a historical cycle documented across 6 centuries, 7 stages, 4 currencies, and now a 5th following the same path.
The only question is whether you will see it before it completes, or whether you will be the liquidity, the wealth transfer mechanism that moves money from those who didn't prepare to those who did.
The pattern is clear. The timeline is evident. The dollar is in stage 5, and history says stage 6 and 7 follow, not as possibilities, but as probabilities bordering on mathematical certainty.
This is how reserve currencies die. Not with invasion or catastrophe, not with dramatic announcements or obvious collapse, but with mathematics. Slow, then fast. Ignored, then undeniable. And by the time everyone sees it, the transition is already complete.
The pattern is played out 4 times, 80 to 110 years, 7 stages, and it's playing out again right now in real time, whether we acknowledge it or not.
The question isn't whether the dollar will follow the pattern. History has already answered that. The question is whether you'll position yourself before it does. Whether you'll be among those who saw it coming and prepared, or among those who believed this time is different until it was too late.
4 currencies, 6 centuries, 1 pattern, and the 5th currency is following the script with mathematical precision. The stage is set, the timeline is clear, and the final act is already in motion.